All right, so for the next few minutes, we're going to break down one of the most powerful and yet beautifully simple tools for building wealth, the index fund. If you've ever felt that investing is just, well, too complicated, stick around. This one's for you. Okay, so let's just dive right in with the central question every single investor faces. Doesn't matter if you're a beginner or a seasoned pro. Should you be trying to outsmart everyone else to pick the winners? Or is there maybe a smarter, simpler way to play the game?
To really get a handle on the power of index funds, first, you got to understand the two main philosophies in the investing world. Think of them like two rival champions in a ring, each with a totally different strategy for winning. So on one side, you've got the active fund. This is your heroic stock picker. You've got a fund manager and a whole team of analysts working around the clock trying to find those hidden gems, those stocks that are going to beat the market average. And then on the other side, you've got the index fund, the humble market follower. Its goal isn't to be a hero at all, it's just to own the entire market and, ride its success.
So, what is an index fund at its core? Well, think of it as a passively managed fund. There's no manager making bets or big calls. Instead, the fund just automatically buys all the stocks in a specific market index, like the Nifty 50, which is just a basket of the 50 biggest companies on the National Stock Exchange, and then it just holds on. It's really that simple.
And this is where the mindset really shifts, which I think is so interesting. See, active investing is all about trying to find that one winning needle in a massive haystack. An index fund just says, hey, why not just buy the whole haystack? That way, you are guaranteed to get the market's average return, minus a tiny, tiny fee. And believe me, that tiny fee makes a huge difference over time.
All right, now for the main event, the head-to-head comparison. We're going to put these two rivals in the ring and score them on 4 really crucial rounds. We're talking cost, management, return, and transparency.
And this table just lays it all out, plain and simple. First up, cost. Index funds are way cheaper because you're not paying for a whole research team. Then there's management style. It's basically simple automation versus active, hands-on stock picking. Now the return is the key here. Active funds have the potential to outperform, but that also comes with the very real risk of underperforming, big time. And finally, transparency. With an index fund, you always know exactly what you own. It also means less stress and way less temptation to constantly check your portfolio.
And this is the knockout punch. This isn't just a theory, okay? This is backed by decades of data. Once you factor in their higher fees, most of those heroic stock pickers actually fail to do better than a simple, boring index fund over long periods of time. So after that whole showdown, who comes out on top? Well, look, there's no single best for every single person out there. But for the average person investing for the long term, a pretty clear winner does emerge.
So who is this really for? Well, it's for anyone who wants a clear, straightforward path. If you're investing for the long haul, maybe for retirement, if you're just starting out and want something simple, or if you just believe that consistently getting market returns beats chasing some elusive jackpot, then yeah, the index fund was basically designed for you. Ultimately, it really just boils down to this powerful formula. You've got low costs plus broad market diversification, and that equals an incredibly efficient engine for building wealth over time. See, those low costs mean more of your money actually stays invested and working for you. And that's where the magic of compounding really kicks in, turning small, consistent savings into some serious wealth down the road. Okay, so now that we've seen why index funds are such a powerful choice, the next logical question is, well, how do you actually do this? How do you put this knowledge into action? And the great news is, it has never been easier. In India, you've got 3 main ways to go. First, you can go directly to the fund company's website. That's called an asset management company, or AMC. Second, you can use a popular online broker, which makes the whole process super simple and lets you see all your investments in one place. And third, if you want to buy something called an index ETF, which is just an index fund that trades like a stock all day, you'll need a demat account to hold your shares. And what are you actually buying into? Well, these are the big ones. A Nifty 50 fund gives you a tiny piece of the 50 largest, most stable companies in India. A Sensex fund is pretty similar. It tracks the top 30 on the Bombay Stock Exchange. And if you want a little different flavor of growth, a Nifty Next 50 fund invests in the next 50 big companies. They're still large, but maybe have a bit more room to grow. Your choice really just depends on your long-term goals. So we'll leave you with this one final, really powerful question to think about. The logic of index fund investing is just beautifully simple. If you can pretty much win the race just by matching the average,
Why on earth would you pay more to risk falling behind? It's a question every single investor should consider on their own journey.